All right, good morning, everyone, and Happy New Year. Thank you for joining us. We're excited to see you here for yet another episode of TaxCraft, which is iTiMS quarterly tax call. And here we discuss the latest updates as affects you, your business, and the world around you. My name is Salam Elea. I'm the Human Resource Officer here at iTiMS Tax, and I'm going to introduce my colleagues coming after me for the presentation. First is Robert Waruiro, who's our tax partner, and then Luke Njeru, tax manager, and Margaret Mutinda, who's a tax and regulatory advisor. Now, before I hand over to them, please note that first, my colleague Mercy is going to upload a link to our survey. Please do take a minute to fill it out. We would love to hear from you. Lastly, we're going to have a Q&A session after the presentations. Please put your questions into the chat, and we will get to them as time allows. Now, without further ado, Luke, over to you.
Thank you so much, Salame, for the introduction, and a Happy New Year to each one and every one of us who have joined us in this call. And we are glad to have you in this first TaxCraft for the year 2026. And allow me to take you through the discussion outline for today's call. We shall begin with the various developments that happened in the last quarter of 2025, both locally and internationally. We shall look at the recent case laws that have been decided in the last quarter of 2025. And then we shall look at what is the outlook for the year 2026. And lastly, we shall have an interactive session where we shall discuss your comments and also respond to your questions. So without any further ado, allow me to take you through the 2025 developments that happened in the last quarter. And one has been, was on the appointment of the KRA commissioners, where the one was on the Commissioner for Micro and Small Taxpayers Department, Mr. George Obel was confirmed as the commissioner. And also there was appointment of two new commissioners, and one is the Commissioner for Business Strategy, Technology and Enterprise Modernization. And another commissioner is in charge of the Tax Research and Analysis Unit. And based on these appointments, they are basically to enhance or to enable KRA to achieve technology modernization and achieve evidence-driven tax policies agenda towards increasing their tax revenue. In December in the last quarter of 2025, we saw KRA publish a notice that effective 1st January 2026, they will be validating any income that will be declared and also the expenses that will be declared in the 2025 tax return. And then this notice, for income tax purposes, for income declaration, they'll be able to verify whatever income has been declared on the eTIMS system versus whatever you are declaring. Also, for persons who are exporting, to be able to verify the exports based on the customs data versus whatever declarations will be done in the income tax return. Also, there will also be for persons who provide services which are chargeable to withholding tax. They also be able to verify based on their withholding tax data. Can they be able to? They'll be able to verify against the income that will be declared. For expenses, this is in line with the Section 16(1)(c) of the Income Tax Act, which was brought in by the Finance Act 2023, which means that for you to be allowed an expense to be allowed for deductibility, that expense has to be eTIMS compliant. In this week, KRA had a discussion with the ISPAC to be able to maybe give them an update on how they'll be able to ensure transition of these new change. And based on the discussion with the ISPAC this week is that KRA will be able to verify the incomes and the expenses for the year 2025 in phases, whereby the first phase will be for individuals whose income they only earn employment income. For that case, KRA will just be able to, they will not be required to verify that income, because essentially the PAYE returns for those employees, they have been declared by their respective employers. The second phase will be for individuals who are earning other income, and therefore KRA in this in their proposal is that they'll be able to auto-populate the various income and expenses that have been declared by these persons, and therefore they will share that data with the various individuals, and then they'll give a span of 3 months whereby the the taxpayer will be able to verify whether they are in agreement with those populated data and file within the 3 months. The second phase will be for corporate, and in this phase also KRA will be able to share the populated data with the corporates, and therefore they'll be given a specific timeline where they'll be able to verify the data that has been populated and be able, in case there is any queries, they resolve it with the KRA and file the tax return. And this will be discussed further by Robert when we will be looking at the 2026 outlook, whether we will be expecting any tax amendment bill or a miscellaneous amendment bill. There has been automation of the bank guarantees for integrated customs management systems, whereby for custom purposes, persons who wants to have a bank guarantee, there is no any requirement for you to be able to have an a manual intervention between you and the Kenya Revenue Authority, which essentially improves efficiency, transparency, and also ensures that the system is automated. KRA has enhanced the tax compliance provisions in terms of on iTax. For you to be able to renew your tax compliance certificate, you are required to be eTIMS compliant. Effective 1st February 2026, we expect the new changes in the NSSF contributions. And this is the fourth phase of the multi-year overhaul of the NSSF contributions, whereby we expect the rates to increase from the current 4,320 to Kenya shillings 6,480, which results to an increase of 2,160. KRA has also issued a public notice of automating the payment plan, and in this case, it means that if a taxpayer has any outstanding tax liabilities, that particular taxpayer can be able to automatically log in on the iTax system and apply for a payment plan automatically. And therefore, and this particular payment plan is stipulated that it is only applicable for a period of only 6 months installments. In case you need an installment higher than the 6 months, you need to make an application or to visit KRA for further increase in the payment plan installments. KRA has also on the iTax have delinked the VAT obligation from other tax obligations, and this is in line with the administrative guidelines that KRA provided in the year 2025, whereby a person who wants to register for the VAT obligation, that particular person is required to go through an interview with the Kenya Revenue Authority so that KRA can be able to address this issue about the missing trader. In December 2025, there was a notice that for you to be able to utilize any of a payment adjustment voucher or installment adjustment vouchers, you are required, KRA will do a verification of those OAVs. Unlike before, prior to December 2025, a taxpayer who had any overpayment, he or she could be able to utilize those OAVs and AIVs without any verification. KRA also published the list of reportable jurisdictions for common reporting standards. And for the benefit of our audience is that common reporting standards is a framework for automatic exchange of financial information between one jurisdiction to another so as to combat tax evasion. And based on these reportable jurisdictions that KRA published, it means that KRA has a visibility of the foreign transactions that are happening for those individuals in those foreign bank accounts. Through the standard levy order number 2025, there was changes in terms of the standard levy that are payable by manufacturers, which means that for you to be able to make a standard levy contribution, you are required to account for 0.2% of the turnover of the manufactured goods, which excludes any discounts, VAT, and excise duty, and it is capped at 4 million shillings for the first 5 years, and the next, after the 5th year, it is capped at 6 million. However, in January this year, the High Court has issued injunctions of the implementation of this standard levy, and therefore we shall keep you posted on the developments at the High Court. There has been an enhancement on iTax whereby for foreigners who wants to apply for PINs, they can be able to make those applications also through the Kenya investment, which means essentially a foreigner doesn't require to be able to make those applications directly to the Kenya Revenue Authority. As long as they are registered with the Kenya Invest, they can be able to make those applications for their foreign PIN. In line with the provisions of the Section 23A of the Tax Procedures Act, we have seen KRA reminding the fuel stations they have to issue eTIMS compliance invoices so as to ensure that KRA can be able to have a visibility of the transactions that are happening on real-time basis. In 2025, we saw KRA published the Advanced Pricing Agreement Regulations, and Advanced Pricing Agreement Regulations, or APAs, is a framework which was brought in by the Finance Act 2025, which became effective from 1st January 2026. And based on this agreement, they allows taxpayer to agree in advance with the Kenya Revenue Authority on the transfer pricing methodologies between the related parties so as to ensure or to reduce any tax dispute between the Kenya Revenue Authority and the taxpayer. And in these regulations, just in an overview, they are guided through the Section 18.3 of the 18.3, 18A, 18G of the Income Tax Act. And the process of the APA starts off by having a pre-filing meeting request between the commissioner and the Kenya Revenue Authority. And this particular pre-filing meeting has to be held 12 months prior to the covered period. And in this pre-filing meeting, KRA will request various documentations, which includes like transfer pricing, financial statements, and any other relevant documentation for purposes of KRA to review and deem that they can be able to allow that taxpayer to be able to take advantage or to be able to apply for a APA. KRA, after that pre-filing meeting, will issue a decision to the taxpayer within the 30 days. And once the taxpayer receives that decision, the taxpayer will be able to fill in an application form to the Kenya Revenue Authority within 30 days. And after the 30 days, within the 30 days as the taxpayer is making this application, they will be required to pay an unrefundable application fee of 5 million if it's a new application, and in case of a renewal, to pay at Kenya shillings 2.5 million. And every year of the after every year end, within the 6 months, a taxpayer who has been enjoined on this APA agreement, APA, will be required to file a compliance report with the Kenya Revenue Authority. And you expect maybe KRA will be able to give us more limelight in terms of what is this compliance report, what does it entail, and what other documentation do they require for that taxpayer to be able to file. The APA time frame only lasts for the 5 years, and after the 5 years, now you can be able to, in case the taxpayer wants to enjoy or to have to renew that APA agreement, they'll be required to pay the 2.5 million as earlier mentioned. So lastly, allow me to take you through the minimum top-up tax regulations that were issued. And the minimum top-up tax, these are OECD Pillar 2 framework that were designed to prevent large corporate or large multinational entities from avoiding tax by shifting tax profits to their low tax jurisdictions. And it is applicable to any multinational groups with a consolidated annual revenue of 750 million euros in at least 2 years of the 4 years of income preceding the tested year of income. The minimum tax rate is 15%, and the computation for minimum tax is given by 15% minus the combined effective tax rate, and the combined effective tax rate is computed by taking any adjusted covered taxes in those jurisdictions, dividing by the net global income. Then once you get that one, you multiply with the excess profit, and then you add any additional top-up tax. After year end, within the 4 months, entities that are covered or which will be affected by this minimum top-up tax will be required to file top-up tax returns and the global information tax returns with the Kenya Revenue Authority. Lastly, the public participation for these regulations the closes on today, which is 16 January 2026. Allow me to invite my colleague Robert to take us through the various developments that have happened in the global space. Over to you, Robert.
Thank you. Thank you very much, Luke. And indeed, there's been quite a lot of developments in the last quarter. But looking further afield, what have we seen? The first thing we've seen in West Africa is Ghana has actually moved to increase the VAT registration threshold. And that has moved from 200,000 Ghanaian cedis to about 750,000. That's roughly 2.2 million to about 9.3 million. And it's an interesting one. Why? Because we think that under the medium-term revenue strategy for Kenya, we have delayed in terms of increasing that VAT threshold, which has actually been in place for around 19 years now. So it's something that we'll definitely continue watching and keep you updated. Another thing is the US. From a US perspective, and you've seen the Trump administration on making America great again, focusing on ensuring that they are shoring up their revenues. And one of the things that they have done is that the Treasury has issued regulations effectively saying we are going to tax controlled commercial entities of governments. So if you've got commercial entities, and probably a lot of this would be Chinese, if you've got commercial entities operating in the US, then they are going to be subjected to US income tax, which is an interesting one. And then in the UK, we've seen a very, very interesting move where the UK crypto dealers or transactions have to be disclosed to the UK Revenue Authority, that is HMRC. So that what that means is that any platform providers, like CoinPass and so on, would have to now declare this information to HMRC, and then HMRC will follow up to ensure that the persons who are trading in these assets do get to pay tax. Why is that an interesting one? Is because in Kenya, if you remember, Finance Act 2025 removed that provision of digital taxation of digital currencies or cryptocurrencies. And so it's an interesting one because we want to see whether Kenya will now revert to that. So that's what's happening in the UK. Now in West Africa, again, going back to West Africa, it's an interesting one for us to watch. Why? Because you remember last year, Nigeria had a very, very extensive review of the tax laws. And one of the things that changed in Nigeria was that there was a consolidation. They, for example, increased the amount that is the minimum income tax, and the minimum income that you earn before you pay tax, which comes to about 72,000 shillings, which is a good one. So all those laws are now coming into force on 1st January 2026, and we're going to continue watching the implementation plan and keep you posted. Again, in West Africa, if any of you has ever traveled to West Africa, you will realize that air flight is quite expensive there. And part of the reason is because they have got numerous taxes. In fact, they've got one called a security tax. I don't know what security tax does, but essentially the ECOWAS group has come together and said, we want to remove all these taxes so that we can make transport in West Africa cheaper. So effective 1st January 2026, that has also now been removed. That is air ticket tax. Lastly, in Nigeria, still in terms of its international obligations, particularly from a common reporting standard perspective, Luke has just told us about the Kenya perspective. So Nigeria now has moved to require that for you to operate a bank account, you must have a tax identification number, TIN, which means that Nigeria is preparing for its CRS reporting, common reporting standards obligations, just like Kenya has done. And it's useful to also note, by the way, that some tax jurisdictions have already shared information with Kenya Revenue Authority. In particular, the Swiss Tax Authority, STA, has already shared that documentation or information with Kenya Revenue Authority. So it's going to be an interesting year as Revenue Authority comes across that data and analyzes it. So that's what we are watching, and we continue watching what the developments are. Ethiopia has come up with a requirement for eTIMS. Nigeria has a requirement for VAT fiscalization. So all these developments we are watching, and we'll keep you updated. Allow me now to invite my colleague Maggie to just quickly walk us through the case law, and then let's see what has happened. Maggie?
Thank you, Robert. It's been particularly an interesting quarter for case law development. Starting us off is a decision from the Supreme Court of Kenya in the Barclays case, Barclays Bank of Kenya, which is the now Absa Bank PLC versus the Commissioner of Domestic Taxes. In this case, it's a long-standing dispute over how banks should tax their fees on card transaction. We see the commissioner had issued withholding tax demand for payments which were made to card companies and also interchange fees, saying that these were royalties and management and professional fees, respectively. However, the Barclays Bank objected to this assessment, saying that these fees constituted commercial service fees. For that reason, they should not be subject to withholding tax. The Supreme Court of Kenya, in determining this issue, stated that taxation must be guided by legislation, and since the payments themselves did not fall under the definitions stipulated under the income tax of the royalties and also of the management and professional fees, the withholding tax would not be applicable. Moving on to the next case is the county government of Kisii versus the Commissioner of Domestic Taxes, which was heard before the Tax Appeals Tribunal, the TAT, where the question for determination was whether withholding VAT is applicable for non-VAT registered persons. In this case, the county government had procured some supplies from the non-registered VAT persons and failed to withhold VAT. The respondent, the commissioner in this case, he stated that since the county government is a registered withholding agent under Section 42A of the Tax Procedures Act, he has the power to withhold on behalf of non-registered persons, and for that reason, he should have withheld. Surprisingly, the TAT agreed with the commissioner in this point and said that Section 42A of the Tax Procedures Act does not exempt non-registered VAT persons, and for that reason, the county government should have withheld on the payments it made to the non-registered VAT persons. An interesting one is Vijay Patel versus the Commissioner Legal Services and Board Coordination, which highlighted very clearly the statutory timelines for issuance of assessment. In this case, we see Vijay Patel was running a rental business for which the commissioner conducted several audits. He disallowed and issued an assessment in 2025, disallowing declared tax losses which were carried forward. These losses were declared in 2014. Vijay objected to this assessment, stating that 10 years had lapsed, and therefore these assessments were statutorily time-barred. The TAT, guided by the Section 31 of the Tax Procedures Act, indeed agreed that the respondent had erred in issuing an additional assessment beyond the 5-year period without proving any negligence, fraud, or evasion by the taxpayer. And for this reason, Vijay's claim was upheld. Moving on to the High Court, we see an interesting case of the Commissioner of Domestic Tax versus Danish Constructions Limited, which one of the questions for determination was whether who holds the evidentiary burden for input VAT claims where there are missing traders. In this case, Danish had claimed some VAT from missing traders being untraceable suppliers. The commissioner disallowed this input VAT, stating that the Danish had not proven that these were indeed valid supplies. Danish stated that since it had adduced invoices and ETR receipts, it had already fulfilled its evidentiary burden pursuant to Section 17 of the VAT Act. However, the High Court in this matter disagreed and stated that where there are missing traders, the invoices are not sufficient, and therefore it was incumbent upon the taxpayer to produce and adduce more evidence to show there was a transaction reality. And therefore, in this case, the input VAT was disallowed. A fourth case is a Commissioner of Investigations and Enforcement versus Hanking Zhao, which was heard in the High Court and highlighted clearly the issue of validity of objection, where the commissioner had issued an assessment, which Hanking Zhao objected first using a physical letter through email, and much later he objected through the iTax portal, for which the commissioner responded to and issued an objection decision. At the point of High Court, Zhao challenged this objection decision, stating that it had been filed beyond the 60-day timeline that is provided for under the Act. However, we find that the High Court held that for a valid objection has to be filed through the iTax portal for it to trigger the statutory timeline. Since the first one was not filed through the iTax portal, it did not trigger any statutory timeline of the 60 days provided, and therefore the objection decision was held to be valid. Lastly, we see another interesting case from the High Court, which is the Commissioner Domestic Taxes versus ICA Lion General Insurance Company, which one of the core dispute was whether VAT is applicable for disposal from proceeds of disposal of salvaged motor vehicles. The commissioner argued that this was the disposal of salvaged motor vehicles is a standard sale and therefore it should be subject to VAT. However, we see the High Court disagreeing and stating that looking at the contract of indemnity, this is not the last step to this contract is the disposal of the motor vehicle, where the insurer after indemnifying the insured, he steps into the shoes of the insured to exercise the rights on behalf of the insured against third parties. For this reason, all disposal on salvage motor vehicles were held to be VAT exempt. That's just but a few highlights from this quarter. I hand it back over to you, Robert.
Yes, thank you. Thank you very much, Maggie. A lot of decisions have come through and we will continue watching those ones. Now, what is the outlook for 2026? The first thing to note is that the National Treasury had called for proposals for the Finance Bill 2026, and those proposals closed on 31st of December. We now understand that National Treasury is looking through those proposals and we'll work through them to come up with the draft Finance Bill 2026. So we hope that everybody has had their say and certainly will continue having their say. Now, the next thing that is important to have a look at is where Revenue Authority is and was. Coming into December, that is end of November, Kenya Revenue Authority was about 83 or so billion behind target. But December was a very, very good month for Kenya Revenue Authority, particularly the large taxpayers office, because now that deficit has gone down to about 52 or so billion shillings. And so half year has closed with a smaller gap, which is a really, really good thing. And then looking forward to the coming quarter, which is quarter 3 for the government ending March. One of the things that we understand Kenya Revenue Authority is doing is going on an extended drive to bring in additional taxpayers. They are looking to bring in 3 million, at least 3 million taxpayers, and not just in registered persons, but taxpayers, people who are paying taxes. And so how are they planning on doing that? Number one, KRA will shortly be rolling out what they're calling an income estimation algorithm. Essentially, what this means, ladies and gentlemen, is Kenya Revenue Authority has got data from numerous sources: lands, for stamp duty, they've got utilities, they have got from NTSA, from Civil Aviation Authority, from schools now even. And so basically they will do a profile of taxpayers who are filing nil returns and then compare that profile with what people have filed. As a result of that, the algorithm will give you an estimated income. In other words, if I file a nil return and the algorithm shows that I dug a borehole and we know that digging a borehole costs 2 million shillings, then the question will be, where did you get these 2 million shillings to dig the borehole? That's how this algorithm is expected to work. So it will be an interesting one, given the kind of pressure that Revenue Authority is under to drive more revenues. The second thing is that they're going to deploy what they're calling a risk-based intelligence system. In other words, they will not be going for everybody. They will be going for those persons where the system has flagged as a high risk. And it's not unique to Kenya. We've seen it, especially in the West. If you go to the UK, Europe, audits are generally risk-based. So if you are not a risky client or you're not a risky taxpayer, then the IRS or the HMRC is not really interested in reviewing your affairs. However, if the system flags you as a risky person, then for sure you'll be audited. So that's where the KRA is going with this. Luke talked about the missing trader phenomenon, and Maggie also talked to us about that case. So where Revenue Authority is going, because this is a real big issue. Actually, if you think about the VAT performance, according to KRA, the VAT performance is actually fluctuating because of the missing trader phenomenon. So one of the things that we expect is that there's going to be a big push around the missing traders, and particularly that there's going to be some prosecutions, or at least there's some prosecutions that are proposed to be done just to fight these vice. Now, speaking of the missing trader, a lot of you or some of you may have gone into the special table, and it's a real nightmare to get out of. In fact, I saw some statistics which were quite shocking. About 100,000 people have been put on the special table, and about 80,000 or so have been on that special table for 2 years, which is a real problem. But if you think about it from the other side, if you've been on the special table and you've stayed for 2 years, then is there a problem? Is there something that Revenue Authority should be knowing? That's a question that they're asking themselves. And so we expect that the Revenue Authority will come up with guidelines around rolling out people or removing people from the special table. So we expect those guidelines to be issued imminently. So that's what's happening or what we're expecting to happen in the next half year. But a very important one, and Luke addressed it, was the issue of tax filings. Actually, I looked at my own tax return, and it's been pre-populated. When it's loading, it's like watching a movie. Your screen is moving up and down because of the macros in the background. So these returns have been pre-populated, and like we've said, for individuals, you have, well, the proposal is to bring an amendment law, which is why we're talking about a miscellaneous or tax amendment bill 2026, bring it in to highlight the obligations of filing, so that as an individual under phase 1A, I have until March, for example, to look at my pre-populated return, and then I've got 3 months to query and amend that return. So we expect that there's going to be an amendment bill before the finance bill. So it looks like it's going to be a very busy quarter or half year if this bill does actually come through. So there's some those are some of the proposals that KRA and National Treasury are discussing. It'll be interesting to see what finally comes through. So we'll keep you posted as these developments evolve. The next thing is that we've now gotten into the budget cycle, and we expect the National Treasury to submit the budget policy statement to the National Assembly on 15th of February as required under the Public Finance Management Act. And so we'll keep an eye on that one. However, we do know from the draft that there's been a lot of focus on infrastructure, on housing, and on healthcare. So it wouldn't be a surprise to see a lot more proposals targeting those particular areas. And again, we all understand that we are just 1 year away from the election, so it's likely that we'll see a lot of noise around that. Lastly, we think that not lastly, but the submission of the draft budget estimates is expected to be done on 28th of April 2026, again in line with the Public Finance Management Act, and that is when we also expect the Finance Bill 2026 to also be tabled, because that's one of the documents that is required to be tabled under Section 39 of the Public Finance Management Act. Then once that is tabled, of course, there will be public participation, and then the culmination of that will be the budget policy statement being read or the budget statement being read by the CS National Treasury, and in keeping in line with the East Africa community traditions of finance ministers reading the budget on the last Thursday before 15th of June, we expect that that budget will be read on 11th of June 2026, and we'll continue keeping you posted. So ladies and gentlemen, that's just a snapshot of what we expect in the quarter, in the coming 2 quarters. We expect that to be a pretty busy period, and certainly we'll keep you posted. Thank you very much, and back to you, Salame. We can hear you.
Thank you. Thank you for that presentation. Very eventful last quarter, and indeed much more to look forward to this coming year. We have just a few minutes for our Q&A, and to start us off, Collins Pamba Bob would like to know on income and expense validation, if he declares income which is more than what was declared on eTIMS, and if he declares that on iTax, is that allowed? Will the system allow that? And how is it going to validate expenses?
Yes, thank you. Thank you very much for that question, Collins. So let's start by this. If you declare more income, I don't think anybody will refuse to take that income. Certainly not Kenya Revenue Authority. So if you declare more income, the system will allow you. Actually, the system has been designed to allow you to increase your income, but you cannot increase your expenses, which is why they are talking about these interventions that are going to come in the miscellaneous tax law amendment bill. So the idea, or at least as we understand it, is that there's going to be an opportunity for taxpayers to validate those expenses. And then also, because some people have asked, but I deal with governments and I pay my license and I don't get an eTIMS. So what KRA has done is that they have collected a lot of that data, and as an individual, if I pay a license, I'll be allowed to claim that because my PIN is mapped to that license expense. So there's a lot of work that is going in the background to validate, but we know that there's going to be a big challenge. Actually, if you look at some of these jurisdictions like Egypt, like Rwanda, which have rolled out eTIMS validation, expense validation, they have done it in phases. And one of the things we've asked Revenue Authority to do is to consider deferring this expense validation and roll it on a pilot basis, probably with some taxpayers. So we continue waiting to see how that will be done, but definitely a challenge.
Thank you for that. There is another question on the chat. Carol Kariuki would like to know, what is the guidance on reverse invoicing for eTIMS?
Yeah, now that's a good question, because reverse invoicing is where I, as a person who is buying the goods or services, issue the invoice myself because the supplier is not able to issue that invoice. It's something that is being piloted. We know that it's being piloted with some taxpayers in the large and medium taxpayers office. It's not yet been fully rolled out, but we expect that once it's fully piloted, it will be rolled out and people will be able to issue those invoices. We've seen it in the tea sector. It's a bit of a challenge because sometimes the supplier is not agreeable to validating that sale. So it's a bit of a problem. That's the reason why probably we've not had too much of it. But it's still a solution that Revenue Authority is going for.
All right. Thank you. I think we do have time for one more question, a quick one. How will KRA, I'll read verbatim for you, Robert. How will the KRA repopulate the returns where the WIP, where there was WIP from the previous years, especially in the construction industry, where sales of property is not simultaneous with expenditures?
Yeah, and thanks a lot for that, Dr. Matu. It's a real challenge because, and this is the reason why we're calling for a deferral, because when you're talking about work in progress, that's an expense. How will you validate that expense from previous years? You see, that's a challenge. Sometimes you have capital items that you buy that the system will tell you to expense, but again, because it's a capital item, you cannot expense it for tax purposes. You've got things like provisions that you need to carry in your books, but they're not. You don't have an invoice. You don't have an eTIMS invoice for that provision. So those are some of the challenges that we are telling KRA. You need to think about it, and this is the reason why we want a deferral. But what we know is that for people who are in stock of the trade of buying and selling goods and therefore stocks, KRA will be rolling out that stock module and enforcing it so that it's very easy for you to allocate those expenses. But I do agree that in the construction sector and so many other sectors, by the way, there's certain challenges from an expense validation perspective. Even when you import a service, for example, KRA has no visibility of that, especially if you're not paying reverse VAT. So how how will they validate that expense? Will they disallow you from claiming that expense? And then the next question from Martin Steele is, will the filing of taxes come after verification of repopulated returns? So the idea is that you download your return, you file it, you verify the expenses, you adjust, and then you file. So you've got until June to do that. So we're expecting some more guidance from Revenue Authority in short order, and we'll definitely keep you posted.
All right. Thank you. And ladies and gentlemen, that's all we had time for. But please do interact with us further through our social media handles, or reach out to any of our tax advisors through the emails on your screen. Just a reminder that my colleague Mercy posted a link to a survey. Please do take a minute to fill it out. We would love to hear from you. Now, that's all we're able to cover. We'll see you next quarter. Adieu.